Inflation just came in at 3.8%, the highest it has been since 2023. Energy costs up nearly 18%, groceries climbing, shelter costs still rising. The Federal Reserve's own data confirms it. And here is what the number means for your money right now. The national average savings account is paying 0.38%. Inflation is taking 3.8%. That is a 3.4% guaranteed loss in purchasing power every single year, while your balance appears to grow. That gap has a name. I call it the inflation tax. Today I'm going to show you exactly how much it is costing you, why most people never realize it is happening, and what dividend investors do differently that changes the entire outcome over time. Stay with me because the numbers at the end of this video will genuinely surprise you. Here is the thing about money sitting in savings. It looks safe. The number goes up a little every month. Your bank sends you a statement and you feel responsible. But purchasing power and account balance are two completely different things. Let me show you what I mean. You deposit $40,000 into a standard savings account. Your bank pays you 0.38%. That is the FDIC national average right now. After 1 year, you have earned about $152 in interest. Meanwhile, inflation at 3.8% has quietly erased about $1,520 in buying power. You are $1,368 poorer in real terms, and nothing on your bank statement told you that happened. Now, multiply that across 5 years, 10 years, across the retirement savings of millions of Americans. This is not a small problem. It is a structural one. And the reason most people miss it is because there is no red number on the screen. Inflation does not send you an alert. It just shows up later. When you realize things cost more than you planned for and your savings did not keep up. I want to be clear about something before we go further. Keeping cash is not always wrong. There is a right amount of cash to hold, and we will cover that. But the reason most people hold too much cash is not strategy. It is emotion disguised as caution. When markets are volatile, cash feels like the smart move. It feels like discipline. But consider what was actually happening to someone who moved the cash during the tariff uncertainty and market turbulence of 2026. They locked in their losses and missed a significant rebound. SCHD has delivered double-digit total returns in 2026, while those sitting in cash collected almost nothing. The investors who stayed invested and kept collecting their quarterly dividends, they were getting paid the entire time the market was unsettled. That is the core advantage of a dividend growth approach. Income does not stop because the headlines are loud. Holding excess cash is not neutral. Every month you wait has a measurable cost. The inflation tax runs whether or not you're paying attention to it. Let us look at what the alternative actually produces with real verified numbers. SCHD, the Schwab US Dividend Equity ETF, currently yields 3.34% in dividends alone. That is nearly 9 times the national savings rate, and it pays quarterly so that income hits your account 4 times a year. But the dividend yield is only part of the picture. Over the last 10 years, SCHD's dividend has grown at an average of 9.29% per year. That means the income your shares generate keeps getting larger without you doing anything. If you bought SCHD 10 years ago, your yield on your original cost is significantly higher than the 3.34% it shows today. Now look at total return. $10,000 invested in SCHD 10 years ago. With dividends reinvested, that's worth over $33,000 today. That is a 12.71% annualized return. Through 2 market crashes, a global pandemic, and a period of the highest inflation in 40 years. A savings account at 0.38% over those same 10 years would have turned $10,000 into roughly $10,382 in nominal terms, and actually less in real purchasing power after inflation. This is not a close comparison. The difference is compounding dividends versus a guaranteed slow loss. Past performance is never a guarantee of future results. I always want to be clear about that. But the structural logic of owning quality dividend-growing companies versus holding cash has held up through every economic environment this fund has ever seen. Now here is the part I want you to really hear. Cash is a tool, not a strategy. And like any tool, it works beautifully when used for the right job. Your emergency fund, 3 to 6 months of living expenses, belongs in a high-yield savings account. The best ones right now pay up to 5% APY. That money needs to be liquid. It needs to be safe. And it should stay exactly where it is. Do not touch it and do not invest it. If you have a specific purchase coming up in the next 1 or 2 years, a car, a home, down payment, a business expense, keep that money liquid and stable too. The market can be down 20% right when you need those funds. That is not a risk worth taking for near-term money. Everything beyond that, every dollar you will not need for 3 years or more, that money is paying the inflation tax every single day. It sits in savings. It has a real cost. And now you know exactly what that cost is. I want to leave you with one final picture because this is where the math becomes impossible to ignore. 2 neighbors, same income, same discipline about saving money. Neighbor A keeps $50,000 in a high-yield savings account. A good one, at 4.5% over 20 years. After taxes and 3.8% inflation, they are roughly breaking even in real terms. The balance looks bigger. The purchasing power is barely different. Neighbor B puts $50,000 into SCHD and reinvests every dividend for 20 years. Using SCHD's verified 10-year annualized total return of 12.71% with dividends reinvested, $50,000 grows to approximately $170,000 over 20 years. That portfolio is generating over $5,600 per year in dividends, and that income keeps growing every year through dividend raises. That is not a prediction. That is what the last decade of actual performance produced. Future results will vary, but the structural engine behind it does not change. The wealth difference between those 2 neighbors is not about income. It is not about luck. It is about one decision. What do I do with the money I do not need right now? Dividend investing does not require you to be a genius. It does not require you to predict the market. It requires patience, consistency, and the understanding that your money is never truly standing still. It is either building or eroding. Now you can make that choice with open eyes. The next step is understanding exactly how dividend compounding accelerates over time. Most people dramatically underestimate how powerful it becomes in years 15 through 30. That video is linked right above me. Do not skip it. I'm not a financial advisor. Always do your own research before making any investment decisions.